Dirty dealings, corporate battles, consumer woes. This is Evening 5. The EPF saw its total investment assets grow to 1.21 trillion ringgit as of June this year, from 1.19 trillion ringgit as of end March. The pension fund recorded a distributable income of 17.5 billion ringgit in the second quarter ended June, up 25% year-on-year. The EPF said in a statement that of the 17.5 billion ringgit distributable income recorded in the April to June period, 8.64 billion ringgit or 49% was contributed by investments abroad. Overseas assets make up 38% of its 1.21 trillion ringgit asset base. Cumulatively, distributable income rose 29% from 28.4 billion ringgit in the first half of last year to 36.7 billion ringgit in the first half of 2024. According to the EPF, equities continued to be the main income driver for the fund in the second quarter, generating 10.75 billion ringgit, while fixed income instruments contributed 5.72 billion ringgit. Real estate and infrastructure investments yielded 50 million ringgit, while money market instruments contributed 53 million ringgit. Looking ahead, EPF CEO Ahmad Zulkarnain said that as a long-term investor, the fund will continue its strategy of constructing a highly diversified portfolio, driven by strategic asset allocation. Sunway has been included in the MSCI Malaysia Index, while no constituent was removed in the August review. MSCI Malaysia was designed to measure the performance of the large and mid-cap segments of the Malaysian market. Prior to Sunway's inclusion, it had 32 constituents that covered about 85% of the country's equity universe. The next review, which will be a semi-annual rebalancing, has been scheduled for November 6, 2024. At the end of July, Public Bank, Maybank and CIMB Group Holdings were the index's top three constituents that collectively accounted for 33% of the index weightage. Meanwhile, 6 stocks were added to the small cap index: Aeon Credit Service Malaysia, Dayang Enterprise Holdings, Genting Plantations, Guan Chong, IT Max System and Sunway Construction Group. The index had 64 constituents, which covered about 14% of the Malaysian equity universe at the end of July. The top 3 constituents in this index were Dialog Group, IGM Corporation and Bursa Malaysia. All changes to MSCI indices will be effective at the close of August 30th. Mr. DIY Group Malaysia said second quarter FY 2024 net profit rose 3.3% to 155.21 million ringgit, in line with higher revenue, though this was partially offset by higher expenses linked to its business expansion. The home improvements retailer declared a second interim dividend of 1.2 cents per share, representing a 50% year-on-year hike. Revenue for the quarter rose 8.8% to 1.19 billion ringgit, primarily driven by positive contributions from new stores. Still, despite a 13% year-on-year rise in total transactions, Mr. DIY noted lower average basket size, falling 3.8% year-on-year, which the group attributed to tightening household spend. For the first half of FY 2024, the group's net profit rose 7.9% to 300.1 million ringgit, as revenue grew 9% to 2.34 billion ringgit. Commenting on the dividend payout, Mr. DIY CEO Adrian Ong said the record dividend payout reflects the firm's appreciation to its shareholders and its confidence in growing its business. Ong also highlighted that its investment in the KKV retail chain is expected to deliver future growth by attracting a broader customer base and enhancing the overall shopping experience. A businesswoman who had seen her suits and damages against CTOS Digital Unit, CTOS Data Systems or CDS, being overturned by the Court of Appeal last month, has filed an application for leave to appeal to the Federal Court. CDS's counsel Ashok Kandia, when contacted by The Edge, confirmed that a motion for leave to appeal had been filed to the Federal Court by the businesswoman, Suryawati Muhammad Yusof, who runs a resort on an island off Terengganu. In March, the Kuala Lumpur High Court ruled that Suryati was to receive 200,000 ringgit in damages and another 50,000 ringgit in costs from CDS, as it had not provided an accurate credit rating. It also ruled that CDS was not legally empowered to formulate credit scores and that the company was merely a database of credit information for its subscribers. Last month, the Court of Appeal overturned this decision. It ruled that there was no defamation, no negligence and no breach of statutory duty by the credit reporting agency, and that the decision by the lower court was erroneous. It also ruled that credit reporting agencies do not owe a duty of care under common law, and that they may formulate and publish credit scores. Axiata Group's 63% owned tower company, Edotco Group, signed two separate memoranda of understanding with the Malaysia Digital Economy Corporation or MDEC and Boost Holdings to accelerate Malaysia's digital economy through next-generation digital infrastructure and financial inclusion initiatives. Under the deal with MDEC, Edotco will offer expert advisory services and preferential rates for next-generation digital infrastructure solutions to Malaysia digital status companies. This includes providing 4G and 5G in-building connectivity for Malaysia's digital cyber cities and cyber centres, as well as alternative connectivity solutions such as deploying low-orbit satellites and sustainable smart city solutions. For the MOU with Boost, Edotco will collaborate with the company to introduce the Tower Landowner Credit Access Initiative and provide financial support to more than 2,200 individuals and private landowners with existing tenancy agreements with Edotco. The first phase of the collaboration aims to support SME tower landowners, while the second phase will be expanded to individuals in the coming months. The initiative opens up new avenues for credit access, particularly benefiting those who are unbanked or underbanked.